the last 3 or 4 years, there's an increase in landlords who are just not making any money. They get a lot of grief, they pay a lot of tax, they want to sell the property.
Capital gains tax, up. Stamp duty, up.
So I spent an entire day with an accountant to see if there's a way of legally paying zero taxes despite all of these changes, and luckily there is.
The first year I did the tax return, he had about 6k of income tax to pay on the rental income. I mentioned the form, and the subsequent year they had no tax to pay.
Here are 4 ways to legally pay zero taxes, starting with Form 17.
When you jointly own a property with someone, whether it's a spouse, friend, unmarried partner, that has an implication on how you declare that income. If you are a spouse and you jointly own a property, you have to declare that 50-50 unless you get a declaration of trust in place, which allows you to split that rental income in a different percentage. I've got one client where he's an additional rate taxpayer, so paying 45% income tax, and his wife doesn't work, she just looks after the kids. The first year I did the tax return, he had about 6k of income tax to pay on the rental income, and the subsequent year they had no tax to pay because it was all declared in her name, which is legally able to be done via this process. From quotes I've seen from solicitors, you can get it for about 200 quid. So you go for your solicitor, they will create the declaration of trust. And then once you do that, you file that with something that's excitingly called Form 17 with HMRC. Once HMRC agrees to that, you can then declare that rental income.
In this case, would both the partners have to co-own the property, or could one own the property, but the income could be passed on to someone else?
So you can get a declaration of trust that does that. That sends the income is going in someone else's name who doesn't own the property. Whilst that's allowable, it's open to scrutiny from HMRC when you come to trying to get the Form 17 signed. It might look like anti-avoidance. I would deviate away from that if you can.
So in an ideal world, try to own the property together,
exactly,
as opposed to doing it that way.
Yeah, or at least have someone who is directly in the family. You give that income to a child or, brother, sister.
So let's say you have a limited company where you are the director of that limited company.
If you're paying a salary to yourself as director, you can also claim a pension. As an employer, so the company is technically at that point an employer, they have to provide their employees, which is you as director, with a pension scheme. So you can opt out of that because you are a director, but otherwise you can opt into this and you would have a workplace pension scheme in place. So you as the director, the employee, would make contributions. The minimum is 5% of your salary, but the employer, the minimum they have to pay is 3%. There is no maximum. You can have a really lucrative pension scheme where you contribute 5% and the company contributes 100% of your salary as a pension. And helpfully, HMRC gives no guidance on what is a reasonable amount, but they use the term reasonable. The pension contribution has to reflect the level of work that goes in to managing that company.
So in that scenario, let's say you are a director of a limited company and you pay yourself £25,000 a year in terms of salaries. You can then say, well, actually another £25,000, which is 100% of your salary, is a pension contribution.
Exactly.
So if you now have a limited company which only makes £50,000 a year profit, that £25,000 of that you pay as a salary, £25,000 you pay as a pension contribution, and then you have a scenario whereby you don't actually have any corporation tax to pay because the company hasn't actually made a profit at the end.
Exactly. And whilst that may feel like a little dubious, the government is encouraging people to put into pensions. They want employers to have good pension schemes. They want people to contribute into their own pension scheme. So it's not investigated or frowned upon because that's kind of government policy. So whilst it might feel like you're giving up cash now, it's a future investment. And let's be honest, like the state pension, will that be there when we get there? Like, it doesn't feel that secure. So 10 years ago, there were lots of things I could advise an individual on or a company on how to save tax. Things have changed over this last decade. Everyone's situations are different. Everyone's earnings are different. As an accountant, if I know your personal situation, I can give you better advice than giving you generic advice from gov.uk.
If you would like personalized tax advice from John or one of his colleagues at Tax Scouts, click the link in the description below and get started. Tax Scouts can give you that tailored advice. They have amazing reviews on Trustpilot, and they can even help you with your self-assessment tax returns. Right now, new users can get 10% off. So if you would like to start working with an accountant and work out an accounting strategy which can help you save as much tax as possible, click the link in the description, speak to an accountant, and get started.
Rent-to-room relief is for where you are either a guest house, B&B, or you live in the property with your tenants. And you have to provide a room that has sufficient furniture for such person to live in. And if you meet those criteria, you can claim £7,500 a year of income tax-free. And if it's £7,500 or less that you have an income, you don't need to declare that to HMRC. If you live in the property with a spouse, partner, whatever, and you jointly own that property, then you can share that relief between you both. You don't get $7,500 each.
When it comes to the eligibility criteria, one, is there any criteria? And second, if you have, let's say, a room which is more like an annex in your house, is that something which you can still claim as a room, or is that considered a separate property?
So it depends how you enter the annex. Where the front door is has such a big impact on the tax. There's rules around if the annex has a separate entrance to the property, then it's generally not allowable for the rent-a-room scheme.
If you have a limited company, one of the tricks sometimes people might miss is that if you have a spouse, especially if the spouse doesn't work, or if you have kids who are old enough, it's very beneficial to add them to your limited company, because then once this company has made this profit of, like we say, £20,000, you could pay your spouse a salary of £12,500, which is within your personal allowance, and so therefore there's no tax on that amount. That is a lot of money you can pull out of a limited company with barely paying any tax whatsoever, just because you've added someone else into a limited company.
Yeah, and I've seen all sorts of arrangements where people have, the gran on payroll. If you trust someone and you're close to them, those things are there to be utilised. As long as they've got a national insurance number, then they're good to go. See, I have lots of clients where they have a son or a daughter who is doing an admin role for $12,500 a year.
If you want to implement any of these strategies, get in touch with Tax Scouts, and right now you can get 10% off as a new user by clicking the link in the description below.